money from your 401k sounds completely normal, but most people do not realize that one simple withdrawal can end up costing them far more than they expected, and even affect parts of retirement they never even thought about. David and Susan needed $30,000 for a roof. The money was sitting in their 401k. They took it, fixed the leak, and thought the problem was over. It was not. That withdrawal created extra costs you don't see when the money hits the bank account. Some costs show up this year. Others can show up long after the roof is fixed. So before you take money from a 401k, always ask the following question: what else could this withdrawal affect? Over the next few minutes, I am going to show you the 8 places where a normal 401k withdrawal can become more expensive than you expected. And the first one is the cost most people never calculated before they requested the withdrawal. David and Susan's first surprise is that the roof estimate is not the only number they need to worry about. When money leaves a traditional 401k, it generally lands on the tax return as ordinary income. In plain English, the IRS usually treats that withdrawal much like extra income from a job. So before David and Susan paid for one shingle, part of that $30,000 may already belong to federal taxes. That is the obvious cost. The less obvious costs are the ones that can show up underneath it. That extra income can push more of their Social Security into the taxable column. Their Social Security checks don't shrink, but more of it can become taxable because of the withdrawal. It can also use up room they may have had to sell an investment at a lower capital gains rate. It may shrink an income-based deduction or tax break they thought they were getting. Depending on where they live, state income tax may be added too, and none of those things happen to every retiree. The point is not that every withdrawal triggers every cost, but a withdrawal can touch several parts of the same tax return at once, and you usually don't see that coming where you request the money. Think of it like a receipt. At the top, it says $30,000 withdrawal. Then, underneath, extra lines may start appearing. Income tax, more Social Security taxable, less room for investment gains, state tax, a deduction that gets smaller. The roof still costs $30,000, but the withdrawal may cost more. So before you start withdrawing from your 401k, think about the other costs that could happen if you take $20,000, $30,000, or even $40,000. You don't need to become your own tax accountant. You just need to know whether the next $10,000 is cheaper, or if that will push you into a more expensive part of your retirement plan. Because sometimes the issue is not what the money costs after you take it. It's whether you can still reach it efficiently at all. If you want retirement rules explained in plain English, subscribe to the channel. Before the tax calculation even matters, some retirees accidentally make their money harder to reach. This matters most if you left a job in your mid to late 50s and have been thinking about rolling an old 401k into an IRA. Carol retired at 56. She had an old workplace 401k, and she wanted to simplify things. One account instead of several. Cleaner statements. Fewer passwords. That sounds sensible. So, she rolled the entire balance into an IRA. Then at 57, she needed money. Private health insurance was more expensive than she expected, and a repair came up at the same time. That is when she found out the rollover had removed an option. Usually, taking money from a retirement account before age 59.5 can trigger a 10% early withdrawal penalty on top of regular income tax. But there is an exception that may apply when someone leaves a job in or after the year they turn 55. It is often called the Rule of 55. Depending on the employer plan, it may allow penalty-free withdrawals from that former employer's workplace plan before age 59.5. The important part is this: that option generally applies to money still inside that workplace plan. Once Carol moved everything to the IRA, that particular door was usually closed. This is not really a story about memorizing a retirement rule, but keeping options open. A rollover can feel like organizing your financial life, but it can also remove a choice that only becomes valuable after life surprises you. So, before moving an old 401k, call the plan administrator and ask a few direct questions. Could I request penalty-free access before age 59.5? Does this plan allow partial withdrawals after I leave? And is there company stock or after-tax money in the account that deserves a closer look before I roll it? If you decide to move it, direct transfer between institutions is generally cleaner than having a check paid to you first. The money is not going anywhere. Just make sure your options don't disappear with it, even when access is not the problem. The timing of a withdrawal can take your other choices away. This is the one that catches people who are not doing anything reckless. They simply wait until the expense becomes urgent. It is the 3rd week of December. Frank needs $20,000 because his furnace has stopped working during a cold snap. He knows the money is available and the repair cannot wait. So he withdraws and promises he will sort out the tax side later. Nothing about that feels irresponsible. The problem is not that December is always a bad month to take money out, but by December, many of your best planning choices are already gone, or much harder to use well. Earlier in the year, Frank could have adjusted tax withholding on the withdrawal. He could have planned an estimated tax payment. He could have coordinated the withdrawal with an investment sale or another income event. He may even have been able to take part of the money in December and part in January, spreading the income across 2 tax years. But when the decision happens in the last week of December, the calendar does the decision-making for him. The furnace still gets fixed. The money still comes out. He has almost no room left to shape how it affects the year. That is why a large withdrawal should not be treated like a last-minute decision. If you can see a major expense coming, a car replacement, a home project, medical bills, helping family, start looking at it before December. Even a couple of months can give you room to decide how withholding will work, whether income should be split between years, and what else is already happening on your tax return. The withdrawal itself is usually easy. The timing is what gives you options, or takes them away. And timing is not only about the calendar. Some retirees give themselves plenty of time, follow the advice they've always heard, and still slowly create a problem for themselves. You have probably heard this rule before. Spend your taxable brokerage account first, then use the traditional 401K or IRA. Save the Roth for last. It is clean and easy to remember, and in some situations, it can be perfectly reasonable. The trouble starts when that rule becomes automatic. This matters if you have been spending from savings or a brokerage account while telling yourself the 401k is for later. Picture a retiree who follows that rule faithfully for years. He lives off cash in his brokerage account. He leaves the 401k untouched because that is what he was told smart retirees do. Every year, it feels disciplined. But while he is spending from the brokerage account, the traditional balance keeps growing in the background. Then Social Security starts. Later, required withdrawals begin. And now, the money that was untouched for years has to come out on top of income he cannot easily turn off. The issue was never that he used the brokerage account first, but nobody stopped to ask if there was room to take some traditional money out earlier, while he still had control. That is the better way to think about retirement withdrawals. It is not which account should I empty first, but how much taxable income do I want to create this year? At the start of the year, look at the income already filling up your tax return. Maybe that includes a pension, part-time work, interest, dividends, realized investment gains, and whatever portion of Social Security may become taxable. Then you should ask, how much additional taxable income can I create before the next dollar becomes more expensive? Some years, the answer may be very little. Other years, there may be room to take a controlled amount from the traditional account on purpose, at a rate you are comfortable with. That is why retirement income works more like a thermostat than a recipe. You are not blindly following a sequence. You are adjusting the income level for the year based on what is already happening around you. Always think about how much taxable income you want to create this year, while you still have control. And for some retirees, there is a short period when that annual decision becomes even more valuable than usual. The problem gets bigger when retirement finally gives you a quiet year, and you treat that quiet year like nothing is happening. Imagine you retire at 62. The paychecks are gone, the house may be paid off, you are living partly on savings or a brokerage account. Maybe Social Security has just started, but required withdrawals are still years away. From the outside, this looks very simple and normal. A lot of people think, great, I will leave the 401k alone for now. That may be fine, but it should not happen by default, because these are not just ordinary retirement years. They may be the last years when your taxable income is unusually low and you still have broad control over what appears on your return. Later, Social Security may fill part of the tax return. Required withdrawals may fill another part. A pension, interest income, or investment gains may take up more room too. Once those pieces are in place, you may have fewer years left to make deliberate choices. So don't assume the safest choice is always to leave the traditional account untouched. Compare 3 paths. What happens if you leave it alone? What happens if you take a controlled traditional withdrawal while income is lower? And what happens if you convert a limited amount to Roth in a year when the math genuinely supports it? You may decide that doing nothing is best. That is a valid answer. The mistake is not choosing the wrong path. but letting those decision years pass without ever comparing the paths at all. And when that window closes, the government may begin making part of the withdrawal decision for you, as the flexibility disappears anyway. Once you reach your required withdrawal age, the government generally starts making you take money out of traditional retirement accounts. For many people, that age is 73. For people born in 1960 or later, it is generally 75. Some people who are still working may have a separate exception through their current employer plan. But for most retirees, this is the point when the calendar starts setting part of the withdrawal schedule. And there is one deadline rule that catches people. You may be allowed to delay your first required minimum distribution until April 1st of the following year. A lot of people hear that and assume waiting must be better. But delaying the first RMD does not delay the second one. The next required withdrawal is still generally due by December 31 of that same year. So if you push the first one into April, you can end up taking 2 required withdrawals in a single calendar year, 2 large taxable withdrawals, 1 tax return that can push income higher, make more Social Security taxable, and affect other thresholds that were easier to manage when the withdrawals were spread across 2 different years. So before you delay that first RMD, compare both versions. What does the tax picture look like if you take the first withdrawal in the original year? And what does it look like if 2 RMDs land in the following year? Sometimes delaying is perfectly fine, but sometimes it can create a pileup. The point is not that you should always take it early. Delaying is not automatically free just because it is allowed. And one reason that pileup can sting more than expected is that one of the bills may not arrive until 2 years later. This is where David and Susan's roof story stops being a tax story. They took the $30,000. The roof was fixed. The leak was gone. The contractor had been paid. As far as they were concerned, the whole problem was behind them. Then, 2 years later, a letter from Medicare arrives. Their premium has gone up. And at first, it does not make sense. Their income that year does not feel unusually high. The roof is old news. The money is long gone. But Medicare generally looks back 2 years when it decides whether someone pays an income-related surcharge. The income reported on an earlier tax return can affect what you pay for Medicare now. That roof withdrawal may be the reason the premium changed 2 years later. A past emergency can keep sending bills after the emergency is over. This doesn't happen to everyone. Most people pay the standard Part B premium. In 2026, that is $202.90 a month. The higher income-related charges begin only when income crosses certain thresholds. For 2026, the first threshold begins above $109,000 for many single filers and above $218,000 for married couples filing jointly. It often takes a one-time income spike to get there. A large withdrawal, a Roth conversion, a taxable gain from selling a home, a large investment gain, a pension lump sum. Before a major withdrawal or conversion, look at your projected income for the year and see how close it brings you to the Medicare line. If you are comfortably below it, IRMAA may not be the issue from that withdrawal, but if one large move pushes you over, you may have options such as splitting income across years before the money moves, and those Medicare lines change over time, so use the current year numbers when you run your own estimate. If a qualifying life-changing event caused your income to fall later, there may also be a process to ask Medicare to reconsider. But the best time to see a surcharge coming is before it becomes a surprise letter in the mail. And there is one more cost that doesn't show up on a single tax return. It is the one that can land on the person left to manage the account alone. The longest lasting cost of a withdrawal plan may not land on the couple who built it together. While David and Susan are both here, their retirement plan may fit comfortably. They file jointly, they have wider tax brackets, they have a larger standard deduction, they have more room before Medicare income thresholds become a problem. Their withdrawals may look manageable. Then, David is gone. The year he passes, Susan may still be able to file jointly, so the change does not necessarily happen overnight. The harder shift often comes in the years after. Susan may now be filing as a single taxpayer. Her tax brackets are narrower, her standard deduction is smaller, the The Medicare income thresholds are lower, and the household's Social Security income may change sharply, often leaving the survivor with one benefit instead of two. Here is the part that is easy to miss. The 401k balance Susan inherits may be almost exactly what it was when David was alive. The account didn't shrink. She may inherit the same balance, but with far less tax room to manage it. That is why every married couple with a meaningful traditional retirement account should stress test the plan. Here's what that actually means. Take the withdrawals you were planning and run them again as if one of you were filing alone. Use single filer brackets and a smaller standard deduction. Use lower Medicare thresholds. And consider what the income picture may look like with one Social Security benefit instead of two. If the plan still holds under those numbers, that is good. If it gets tight, that is your signal to consider whether moving some money sooner, while you are both here and filing jointly, could leave the survivor with more breathing room later. Don't only build a plan for the two of you. Build one that can still work for the one person who may have to manage it alone. Before taking money from your 401k, check 4 things. Can you access it without an avoidable penalty? What does it do to this year's taxable income? Does the timing leave you room to manage the year? And what could it do to future RMDs, Medicare, or the person who may have to manage this account alone? Run those 4 questions before the money moves, and a withdrawal stops being a reflex and becomes a decision. If you want retirement rules explained in plain English, subscribe to the channel. I'm Allison, and I read the fine print so you do not have to. I'll see you in the next one.